how we're trying to, make everything be a part of it. Okay. And understanding, the economy, and listen, economists are idiots. Okay. Economists are idiots anyways. So I wouldn't say we'd want to be, like an economist. Okay. Because they're stupid. And again, I'm not trying to be derogatory to them, but they don't get it. They don't get, again, the Fed and the government don't understand how markets function to begin with. Okay. I will say this, that the markets themselves, every asset class has the very innate ability of pricing itself. Okay. Price discovery works if you let it. Okay. If you don't let it work, it doesn't work. Okay. But price discovery actually works if you let it work. Did you know that? Okay. So, we have to remember that, the price of something is worth what you're willing to pay for it. It is something that when you buy, no matter what it is worth, what is it selling for? What am I willing to pay for it? Okay. And if you are not willing to pay what the seller is selling, you don't have a deal. You don't have price discovery. Okay. And listen, price discovery goes on every single day. Okay. Whether you go to the grocery store, because people who go, now I don't, but people who go, when they go shop and, they'll find, where the items are the least expensive. Well, they're discovering the price that they want to pay. Okay. And if you own a home and you're selling it, well, you want to sell it at X, the buyer wants to pay Y. Do you guys discover a price at where both a buyer and a seller meet? Okay. But again, and of course, interest rates do the same thing. Interest rates really could be much higher than they are based on what some of the third-party lenders are getting. Okay. Peer-to-peer lenders, and subprime type lenders, they're getting much higher rates. Okay. But again, like I said, if they would let the markets price themselves, if they let businesses, like the banks, my opinion, not a fact, just opinion, but the banks should have been out of business in the year 2008. First of all, they were not all in trouble. And the only guarantee should have been put out to the depositors of the banks that were in trouble. And the depositors should have been made whole. But why should the bank owner be made whole? Why should the bank be made whole at all? Why are we responsible to keep them in business? Okay. They made bad choices. So does that mean we're supposed to allow them to stay? Okay. Again, think about it. Okay. But to me, it makes no sense. Okay. I'd love to be in a business that I can make horrible decisions that make me billions and billions of dollars. Okay. But if I make a mistake, I get the Federal Reserve to bail me out. Do anybody here have that deal? I'd like to have it. Okay. In the meantime, again, this is just a pregame. Okay. We're going to start at noon, high noon. Okay. So I'm just going to BS here for a little bit. I like to talk markets anyways. And if you have any questions about markets in general, you can feel free to fire them in. Okay. I'm not going to answer any hedging stuff yet, but I'll certainly answer your market questions. But again, experience is looking at the tape. Okay. And as you look, you can start anywhere you want. It doesn't matter. Okay. But as you look at, some of the commodities, for example, cotton going to the moon. Okay. Highs it hasn't seen for years. What does it mean? Well, what does it really mean? Like to the cost of a pair of blue jeans? An actual cost of blue jeans, it means nothing. Okay. It's such a small percentage of the actual cost that is built in between the advertising and the profit margin. But but the retailer will tell you, oh, the cotton's going higher. We got to raise our prices. Starbucks tell you we got to go higher. And Starbucks never comes down. They don't have sales either. So, but you can start there. Okay. And then you go into, let's say cattle, for example. Cattle's on new highs as well. Okay. But again, you can't get it in many of the stores because they don't have a supply chain to get it to you. Okay. And then if you can get it, it might be too expensive. what's going to happen here is the what's up? The budgeting. Okay. People's budget can't afford all this stuff. And the retail chains have already done what? They've already they've made the portion smaller for the same price. So what you used to get 16 ounces, you now get 12. Okay. And you're paying the same thing, but you're really not, right? But again, when it comes to your budget, it'll be, can I afford it? Okay. And remember that the farmer, the producer of those goods, is paying a fortune because they're called input costs. To produce from grains to cattle and hogs, it takes money. It takes lots of money. Okay. And they borrow lots of money. Okay. And they don't get that cheap rate that everybody hears about on TV or that cheap mortgage. They get screwed. Okay. And pay. Well, someone's got to pay for that. Okay. Someone's got to help offset their expenses. They wouldn't be in business. And then what would we do? We went from farming being the background of this world, in this country, to that they don't matter anymore, according to the government. Okay. Now, again, we were like almost 100% service. Why aren't we still manufacturing in this country? Oh, it's dirty. Okay. Or we're too good for that. Okay. I had a guy that worked for me one time, way back when, and he says, I told him to do something. He said, that's beneath me. I fired him, of course, immediately. I said, I do that every day, and that's beneath you. Maybe I'll work for you. Okay. Because certainly the job's got to be done. It's always a time to hedge. Always, my friend. Okay. Again, those of you who try to pick the right time make the very tragic mistake of missing it most of the time. And again, the point is that if you're just always doing it, you're always protected, and the cost is not that great. Okay. Over time, and it will well pay for itself, and you'll never be on the outside looking in, wishing that you did. Okay. It has to be something that is automatic. Okay. But certainly there's always a time, but now especially, of course. I mean, there's some real dangers out there, and because people are going to want to eat protein, but they might not be able to eat beef protein. They may have to go to hogs, which is why hogs have been exceptionally high. If you remember, those who've been around, I said in December, that was the highest December price I've ever seen. Okay. We have lots of fats ready next January. Do we direct hedge on the board? You direct hedge on the board against a ratio, what you're going to learn today, but I know you already know, you've seen it before. But you can talk to me about it later. But I mean, you would use a standard hedge. You never want to give up the upside. That's the key. Okay. Remember, we don't know how high they can explode, right? I mean, do you remember when feeders were 242, 243? Okay. Everybody kept, they're going higher. I said every day I went on the Merck, said sell them. But again, I'm just saying that, nobody knows how high. You never give up the upside of any market, because we never know how far they can go. Okay. So if we hedge properly, we can continue to roll up our hedge and protect underneath it and increase our basis. But anyways, but these are things that come out into play at some point. Okay. Orange juice is very high. It's come down the last few days, but it's very high. And all these are direct expenses to the consumer. And the consumers only have so many goods. And now, if you look at the supply chain, and if you're just tuning in, this is just a free game. We'll start at noon officially. Okay. But if you look in the stores, there's empty shelves. Okay. Now, maybe it's no big deal to you, but it's going to be a big deal at some point. I mean, I was selling an example earlier this morning. I buy from Amazon almost everything I use, okay, that they have that I don't need immediately, that's reasonably priced. I get it auto delivered if it's something I use all the time. But I mean, again, for me, the time to go to the store, the fuel to get there, and my time, it's worth for me. If I paid a few bucks more, I don't, because they're usually the cheapest as well. But even if I had to pay more, it's worth it if I weigh all the other expenses that go with it. But now they're out of goods. Okay. So think about that. I mean, they're unbelievably stocked. I mean, they've got, million square foot warehouses all over the country. And plus they've got, numerous vendors that work underneath the Amazon umbrella that supply them with goods. Okay. And are actually, third-party sellers through Amazon. Well, when they start telling me that they can't get something, and I go to the grocery store, which I only do when I'm in Las Vegas when my wife is there, or when I'm here and she's there, I have to go to the grocery store. And I even see empty shelves at stores that you never thought would have empty shelves. That sounds like a problem to me. Okay. That sounds like a potential issue. And of course, it relates directly to the supply chain. It relates directly to the ports in New Jersey and Long Beach that have record numbers of ships sitting for months in the harbor, okay, that they can't unload. Okay, so look at the monster that we created with the stimulus payments, which were ridiculous, in my opinion. Okay. And tie in stimulus with the Congress taking a raise in the middle of COVID. Okay. Put that together with now, like a McDonald's, you can get $17 or $18 an hour to go work at McDonald's. Think about that. Okay. Which is why McDonald's has to reduce their hours by 10 to 20 to 30% because they can't afford it. Their profit margins aren't big enough to overcome that type of payroll. Okay. So again, you start adding up the potential problems that are out there. And now again, that doesn't mean that it's going to happen tomorrow. This is, again, you have to be very clear on this point. Okay. I'm just pointing out things that will, when we go back and we get this correction, which we're going to get at some point. Okay. And it's not going to be a quick one like we've seen the last two. One was COVID and December of 18 of Christmas, and COVID. Okay. It's going to be one that's going to have some duration and length to it. Okay. But you'll hear the economists telling you, oh, well, we knew there was a recession back in then. And I go, right. Well, why didn't you tell me then? I'm telling you now. But the easiest way to see that, okay, is to just check your own. Okay, just check your own spending. See what you're doing. How is your budget holding up against this? Okay, it's very simple. Start at home. I can tell you about all the problems everywhere else, but you may be doing just great. That doesn't mean that you won't have a problem, but you may be in just great. Again, I don't know what you're doing. But again, I can tell you that, many people that I know are struggling. Okay. Between trying to pay their mortgages and now the high cost of fuel. I mean, I don't drive anywhere. So, I fill up my tank every 2 weeks. If I have to go out, I fill out every 2 weeks. Okay. But there's people that have to fill up 2-3 times a week. Think about that cost. Think about if you're making $75,000 a year and you're spending $300 a week at the gas station. Not a very good spot to be in. Okay. But again, those are things you can look for yourself. The cause and effect of those. Okay. And if you're just tuning in, I haven't started yet. This is just a pregame. I'm going to shut this down in about 5 minutes or so, and then we'll get ready for the actual presentation. But I am in my pregame mode at the moment. But again, look at, you can just roll down the board. Okay, orange juice. Look at, it's come down 10 cents or 20 cents, but it should be around $1. Okay. Coffee is over $2. Okay. And these are all going to be you're going to be paying for all of these at wherever you buy orange juice, you're going to pay more. You buy coffee, you're going to be paying more. So the CPI BS that they feed us is all garbage. Okay. it is as crap as you can get because it doesn't account for the most important things that you use each and every day. That's what people don't get. Okay. The government gives a number and everybody goes, oh, well, that's like the gospel. Well, that's not the gospel is according to who? Like the jobs number yesterday. Okay. That was the biggest bunch of horse manure ever. Okay. Because our unemployment rate is not 4%. Our unemployment rate is 4%, but doesn't include anybody who's been unemployed longer than 3 months. Okay. If you look at what they call the U6, the government goes off the U3, which is 3 months back. Okay. If you go on the U6, people have dropped off the payrolls. So there is no unemployment. It doesn't show up. Okay. Now we could be at zero job. We could be at 0% if people go back to work, but they don't want to work. They like the freebies. And now they're holding out to get more freebies because this administration will bail them out. Okay. So, this is the problem. When you start to make a run on capitalism, I cut my gas use by half working from home. Well, thank God, right? I mean, you drive a lot. You're always in the car for every one of these calls. My calls are expensive, baby. You're in the car. So again, I mean, look, I don't send out panic. I think the best thing to anybody to do is look at your home spending first and see how you personally affected right now. Okay. What are things that are bothering you right now? Okay. And then expand further and then, prorate in your mind. What do you expect? And I don't care what you expect in the market. What do you expect in the economy? Okay. What do you expect in the cost of goods and services? Well, crude oil is probably going back maybe to all-time highs. It's going over 100 again for sure. Okay. I mean, didn't Saudi Arabia say that they would give us more the other day? Does anybody remember that? It's long gone already, right? And oil quickly sold off a little bit, and now it's $6 higher. Okay. So again, remember at whom you're listening to. When the simplest thing for you to do is to say, let me look at my own budget. Okay. Am I still, if you're a saver or an investor and you put away X amount every month, like I put away X every month. Okay. Every month, automatically withdraw. I put away money for my wife and my kids. Okay. It gets immediately drawn out of my account every month, like clockwork. Now that won't be affected. And I won't be as affected as much because I don't have a lot of the expenses that many have. I don't drive around anymore. My basic expenses, the airline ticket going back and forth to Las Vegas. And even in Las Vegas, I only drive 3 miles to the casino. Okay. Back and forth to my house. So even in Vegas, I fill up every 2 or 3 weeks. So gas is not a problem for me. Food is not a problem for me. I don't eat much. Okay. But for a family, you got things to think about. Okay. And again, so you want to think, again, where are you so that you can prepare yourself properly so that you don't have to liquidate. And, actually, when we get in the presentation, it's about being able to hold on to stocks and never sell them because the greatest single investment in history is the United States stock market. Okay. And you can make all the statements you want. The numbers don't lie. Okay. The numbers are the numbers, and you can tell me anything you want, but no place has grown at the constant pace of equities. All right, let me stop this recording. I'm going to get the next one going. Okay, as we get ready to go into our hedging presentation. This was the pregame. If you want it, email me. If you don't want it, don't email me. Bob@bubbatraining.com. But I'll be happy to send it to you if you want it. And but the regular recording will go out to everybody. So all right, let me stop this one. Yes. Okay. And what's up, everybody? Welcome aboard. We're a couple minutes early, so we're going to wait. And I just kind of stall by here as we get ready to present the hedging. And many of you are already current members and seen it before. But for those of you who haven't, I think it'll be quite informed and educated here on at least what you should be doing, even if you're not doing it with me. Okay. I mean, there's many things that I believe, whether, again, I'd love to educate anyways. And hopefully you'll pick up something if you choose not to become a member later. At least you'll pick up something that will help make you better and allow you to get through what promises to be some rough times coming. Okay. Now, again, I'm not a doomsday guy. And for those of you who do know me, I am always long equities. Okay. Because I'm always long and I'm always hedged anyways. Now, I may have trading positions that are short, but net of it all, I'm always long equity markets. I'm always long gold, silver. I always buy gold, silver, platinum and physical basis that I put away, even if I'm short on the board. But in the meantime, so this is our hedging presentation, and it's hedging and protecting your portfolio. And I'm just going to give it another minute. Again, I just want everybody who wants to come to have a chance, because not everybody's used to the fact that I start always 45 minutes early just with a pregame. So, and we are on kickoff. So again, welcome aboard to hedging your portfolio. And of course, at the end, I will answer any of your questions. Okay. And it doesn't have to be necessarily about hedging. I will answer anything you have. You can ask me anything you want. Okay. But again, remember, the markets are never wrong. Opinions are always wrong. Okay. And of course, I have to give you the standard disclaimer, which is, options and futures involve risk, and whatever happened yesterday doesn't have to be guaranteed to happen tomorrow. And you can read it. I'll leave it there for a second again, but it's the standard disclaimer that you always have to read, or we have to read. But again, we are investing here. We are protecting our portfolios. That's our goal of today. Okay. Now, many will ask me, what's the return? Look, I don't know. There is no return. I am not trading this. I am compounding and trying to grow my portfolio without ever having to get out of the market. Okay. I don't sell stocks. Okay. I've never sold stocks, with the exception of those that became fundamentally crap and weak, and I didn't think we were going to be in business. Those are stocks I would get rid of at that time. Okay. But normally I never sell. I continue to hedge and accumulate. The objective of hedging and being able to stay in the market is to be able to compound your portfolio. Okay. That's what you're trying to do here. For those of you who don't know me, I am Todd Bubba Horowitz. I've been doing this this is my 44th year. Okay. Everything I talk about, I use myself as well. Okay. I was one of the original market makers in the SPX, which is now one of the big pits in the world. When we started, we had to build it. We had to build the liquidity before it became anything. Remember, hope is not a strategy. Okay. You can wish and hope, and so I hope I win the lottery. Of course, I don't play, so it's hard to win, but hope gets you nowhere. Okay. Hope is good in life, but not in investing. Okay. And of course, so today we're going to talk about delayed gratification, risk on, risk off. We are investing, not trading, wealth creation, hedging, choices, portfolio mix. I'm going to show you real portfolios. Okay. How you can take advantage now. And after that, I'll show you the IRA catch-up plan, which will use synthetics. And of course, I will then answer all of your questions. So I won't answer any in the middle, but I will answer all you want at the end. Okay. But you first have to ask yourself these questions. How would you like to both protection and potential? Okay. So how would you like to protect your portfolio without giving away the upside? Okay. And how would you like the benefit of compounding without stressing with the market ups and downs? Okay. Two pretty good questions. I think they're fair. I think they're fair to ask. And I think more importantly, you should ask them of yourself. Okay. Now, we are a instant gratification society. Okay. Which is not always good. Right. And, in investing, okay, we need to have a delayed gratification, okay, in our minds set, because investing is not something that can be determined by tomorrow or the next day. It's long periods of time, which means that you have to invest dollars that you can afford and protect those dollars so that they can grow, so that you don't have to sell them. Okay. So when you think of that instant gratification, which we so often have, it is really not a good spot to be in, because it does not give you the benefit of long-term investing and long-term growth and long-term capital gains. Okay, when you get into the short term, you end up on the wrong side way too often. So you have to learn that when you're investing, as long as everything is correct and favorable, that the markets go up over time and have done so for history, which you'll see shortly. And those who believe or play in that moronic risk on, risk off strategy should go see a doctor immediately. It is one of the dumbest strategies, but of course it's not dumb for the advisor, okay? Because the advisor needs to keep you in the market trading so that they get paid, because that's where they make their money on your money being invested, okay? But if you have your money in cash, they're not making money. So they developed the risk on, risk off scenario. Now, if anybody could tell me when it was time to take risk off and when it was time to put it on, then I would never have a losing trade. Okay. That is a bunch of horse stuff. Okay. Markets will do what they do. And you know what? When they decide to go down hard and we go into a real bear market, okay, there will be nothing safe. There will be nothing worth having risk on, risk off. Okay. If you're not hedged, you're going to want to be out. And if you're not out soon, you'll be puking it out. Now, I would advise against puking out in any circumstance, but so take that for what it's worth, but risk on, risk off, ridiculous. The general who wins the battle makes many calculations. Well, again, trading, investing, it's what we're doing here. Hedging is about calculating your proper amount for deposits into your account, the proper sizing of your account so that you don't need the money. Okay, remember, if you over leverage yourself trying to get rich tomorrow, you'll be broke tomorrow, because I guarantee you that there'll come a time you'll be forced to sell something. And when you're being forced to sell it, okay, because you need the money, you're not going to want to sell it at that price, because when it comes to that point, what's going to be happening? Okay, it means that there's something going on in the economy that's triggering you to have to sell it. And you're not making as much money as you were making before. So it means you're going to be selling it at bad prices. So doesn't it make more sense to be invested with money that you can afford and won't need tomorrow? Okay. And that's the general that makes the calculations, that's prepared for all that. Okay? Here's somebody who never traded options before. I thought I would share a positive hedging testimonial for the next class. After the COVID crash last year, I bought and hedged some stock with an account of 30,000. I was able to do risk reversals because I didn't have enough time because of farming. Then the year I had an account with a balance of more than 60,000. From what I experienced, you immediately make 50 to 60% of every up move, and more comes after the compounding. At the beginning of the year, I sold the stock and started legging into risk reversals every week. As a result, my account liquidation is up 14,000 on the year. The auto trading and the back ratio risk reversals is a total game changer and is an absolutely incredible product. I am currently 2.7 times leverage and looking to add more in the downturn. Every day isn't a home run, but it seems to grind out profits, accumulate stock. Thanks for everything you do. And that's a fact. Now, again, I'm not telling you you're going to make money. I'm telling you right now, this is, if somebody asks me, how am I going to do tomorrow or this week or what am I don't know. I have no idea. Okay. I know one thing. You won't have to sell stock. Okay. And if you want to talk about creating wealth, okay, how do you create wealth? Okay, you don't create wealth by trying to day trade and keep compounding up and trading bigger and bigger and bigger with money you don't have that you can't afford. You create wealth by investing, starting into first with very liquid investments, which is the equity markets. Okay, and then as you have more money, okay, and you have extra money that you can then maybe move into some of the illiquid deals. Okay, you can, because there are many great deals out there, but they lack liquidity. So if you were somebody who was investing your last dollars into an illiquid investment, you're probably going to lose. Okay, but most of these if you've ever heard the term family office and those big investment firms, those are what many of them are doing. Is they are using, excuse me, they are using, many of these venture capital deals are not liquid in the beginning. You can't get in and out. It's like when you own physical gold. When you want to sell it because you need the money, it's probably going to be going to loss, and that you're not going to get the edge on the buyer when you have to sell. But remember, it comes to income, saving and spending, investing, which brings the returns. Okay. Well, again, as I said earlier, and I will say more than once, the greatest single investment in history has been the United States stock market. Okay. Over time, it has been the greatest single investment. You can talk about real estate. You can talk about anything else you want, except for maybe Bitcoin, but Bitcoin is not a final score. But that is the wealth cycle. Okay. I only hope someday I can thank you in person. My trading has evolved higher than I ever imagined. Just be relaxed, no panicking, waiting for the trade to come to me is so cool. I would have never made it here without you. And again, what I want to remind you is this. Okay. You cannot let the markets get to you. You got to understand, especially if you're protected, but even if you're not, don't ever sell out of panic. Okay. You will find yourself in much more trouble. Drawdowns, listen, your account will go down just like it will go up. It won't go down as deep and as far when you're hedging. Okay. But it will go down. You'll have down days. Okay. Again, there's nothing to prevent that. Okay. What you're really trying to prevent with the hedging model is the panicking out and puking it out at the bottom of the market. Okay. Which I will tell you, don't ever, whether you become a member of or not, please never panic out of anything. Take a deep breath. Okay. Think about it before you puke it. Okay. And make sure that's what you want to do, because you will more than likely and more often than not have a great regret of what you just did. And it's hard to get it back. It's like saying something to someone and you wish you could take those words back and you can never take it. Well, you can't get the stock back either, because but trust me, I'm telling you, the course of human nature, and you don't want to be on that course. Okay. You want to be on the course that will help benefit you and allow you to stay and survive in the greatest investment. But again, too many people want that immediate, okay, which is a short-term solution. Okay. But if you accept a short-term solution, that's a short-term solution. Okay. This is a long-term problem that many, okay, and I would venture to say many that are here listening today have panicked and puked out their entire portfolios at the worst possible time. And some who might have puked out in 08 are still waiting for a spot to enter. The market's only up, a gazillion from the bottom, but you're still waiting to get in. Okay. So remember that this is, again, delayed gratification. This is a long-term solution to a short-term problem. Okay. If you look for the short fix, you will always lose. Okay. I ask this every time I do the presentation: who caused the financial collapse? Okay. And you will give me various answers of any one of these groups up here. But you know who really caused the financial collapse? Look in the mirror, smile at yourself. If you sold and panicked during that period, you were one of the contributors. It wasn't the high frequency traders. It wasn't the banks. It was the panicking, the panic selling of those who were sitting at home or on their iPhones, dumping their stock as fast as they could because they couldn't take the pressure of the bottom of the market. Okay. And that's what creates the high frequency meltdowns. There is no such thing. That is the biggest core of crap when you hear the pundits talk about high frequency trading and how they are devils. Okay. You never hear them talk about high frequency trading when the market goes up. You only hear about them when it goes down. Okay. Now, I guess high frequency is only sellers. Okay. That doesn't make sense. So but the truth is the big moves come from the panic of you, all of us, because we are our own worst enemy anyways. Okay. I mean, amateur traders want to be right. Pro traders want to make money. What do you want? You want to make money? You want to be right. Okay. I know you'll say both, but again, there's times in hedging, okay, because you can just stay in, you don't have to worry about it. There is no decision to be made other than what is your percentage roll and what are you going to do and how you can handle it is what you learn in the class. So what is this number? 10%. Okay. Well, 10% is the average return, actually 10.5%. I used to quote 8.5. Now it's 10.5. It is the average annual return since 1950. Okay. It would be bigger if you go back to the beginning of the market, which was 1920. But since 1950, the average annual return of the stock market is 10% annually. Now, it's not every year, but again, a couple of good years pick up for the bad years. And the average out is 10.5%. Okay. So figure it out. That's what we're talking about, compounding. Okay. If you can stay in, are you not compounding at a higher level? And, when you were little kids, right? The first kid who'd come up with you want me to give you, $10 or you want a penny a day and I'll double it every day. Okay. And everybody say, I'll take the $10. Well, obviously a penny doubled every day for 30 days comes out to about $5 million. Okay. And that is the beauty of being able to compound your portfolio. Now think about it. When you look at, if you know what the rule of 72 is, which is, the rate of return and the percentage divided into that tells you how fast your money will double. Okay. Now, if you're averaging a 10% return so now you're doubling your original and you're doubling what you've compounded onto it. Okay. So if you're continuing to add to that portfolio, you're getting some doubles. Okay. And then of course, depending on the rates of return, okay, they continue to compound themselves up. Again, doesn't mean it's going to happen. It's not going to happen all at once tomorrow. Okay. What's going to happen tomorrow, if you hedge, is you're not going to worry about the big sell-off. What's going to happen tomorrow if you're hedged is you're not going to get nervous when the market starts to break down. You're going to sleep at night. Okay. But what's going to happen years from now is what some people thought was a good return, an average of 8% or 9-10%, whatever they got. Okay. But they didn't compound it. You're going to find a dramatic difference. It's like the guy who died who didn't have a very good job, but he left $10 million to his cat because he had bought stock and let it compound itself out, because it compounds by itself as well. Okay. I mean, again, we deal in facts. You're your own worst enemy, which is you. I mean, it's facts, not fear. Okay. So preparation, okay, delayed gratification will put you in a position. You don't want to be like these guys. Okay. Mortimer and I can't lost his name, right? I know every other character. Anyways, you don't want to be like these guys panicking out. Okay. Because that's how you lose. You're always wrong. Okay. And again, it's insurance. Now, everybody here has insurance. It's a law. Okay. There should be a law to insure your portfolio. And my question to you is, why don't people want to insure their assets? They insure their life, which they don't even get the benefit from. You got to insure your car, your home. Okay. I want to insure my money. That takes care of the rest of everything. Okay. I mean, hedging is about taking care of risk. You insure your life, health, and car. Why would you insure your money? I never could get that. That's one of those interesting questions I can never get the answer to. Okay. So what is hedging? Okay. Well, it is a risk management tool. Okay. It is a way to offset risk. Okay. At the same time, adding shares. So what you're really doing by hedging with our models is buying shares when everybody else is selling. Okay. And I will give you the perfect examples. In December, Christmas of 2018, the market was collapsing. Okay. Everyone was panicking out. And what were we doing? We were buying. During COVID, what were we doing? We were buying. Okay. We never get out. Okay. We are able to stay in because of the way we have the hedging models set up. Okay. Why do I need protection? Because you're emotional. Aren't we all? Okay. Avoid the fear and panic selling. Keep your long-term portfolio together. And now this is not a trading portfolio. You are not carrying short positions and long positions. You're carrying what you're investing in, and you want to create extra potential yield plus the ability to compound it. Okay. Now, there is no such thing as true diversification because you've seen it before, you've witnessed it, okay, in live time. When they're crapping on markets in general, they're going everywhere because if the equities are getting creamed, they're selling their gold and their silver and other every asset to cover their margin calls in the equity markets. Okay, listen, there's the gold didn't go straight up in '08. Okay, everything went down because they was panicking out there. That's what you got to remember. Okay, you want to be the guy. You want to be like Louis and Billy Ray. Buy them quietly, loading up. Okay, as they're going. Okay, covered calls are as dumb as you can get. Okay, they're not good. They're good for nothing. In fact, they're probably good for less than nothing. Okay. Now, again, 40 years ago with commissions high, okay, but now commissions at nothing. Okay, you're going to give up the upside of your stock to sell a covered call to get a 1% return or a 2% and have no protection of the downside. You tell me where that makes any logical sense. Okay, gold and other precious metals. Listen, gold and precious metals, and I'm an owner and I'm a believer in them. But gold and precious metals are maybe a hedge against currency. They're a good, solid, hard asset like a home, okay, that should appreciate in time. But if you think it's going to protect your equity portfolio, you're nuts. You have no chance that the gold is going to protect that equity portfolio, okay? Non-correlating assets, well, again, I'm telling you that when the world is under attack and panic, they're selling everything. I don't care what grains, cattle, they sell it all. Okay. Puts, again, put options are fine. But again, what's the problem with put options? Well, the only time people buy them is when the horse is already out of the barn and down the road about a mile. Okay. And then they're overpaying for them. Okay. You've heard me tell the story before of a famous baseball player that ran a fund that bought his whole fund. He bought puts in 2008. Okay. When the market was at about 12,600, the market that went down to 6,600 and they were broke and out of business, and he was under indictment because what he didn't realize is that he was so overpaying for them that the market had to go to 3,000 for him to make any money. Okay. And that's the key: time decay and volatility, which our models account for both. Okay. Stop losses, what do they do for you? All you do with those is get screwed. Dividends, listen, dividends are great, but remember, the dividend comes out of the price of the stock. Okay. It's the benefit of dividends is you can buy more stock with money that they're giving you under a better tax basis for yourself. It isn't extra money. The actual funds come from the stock itself. So if you get a $1 dividend, $100 stock, the stock opens at $99 the next day. They gave you $1, which gets taxed at a better rate, and you can either use that to use the drip program, but it doesn't protect your portfolio. Okay. Or you can hope and pray. Okay. Those are your choice. Those are what many of you have done so far. Okay. But it's time for you to make smarter choices. Okay. Again, there's all kinds of ways to skin a cat if you want to do it properly. That comes back down to you and who you are. And if you're ready to make that step that says, hey, I want to come and protect Randolph. Thank you. I want to protect myself. I'm tired of panicking out and selling at the bottom of the market. Now, I traded on the floor. 87, I was on the floor and watched it when they were buying put options as if the market was going below zero. I was on the floor in 2001 in the NASDAQ crash, and I was on the floor in 2008. Okay. So I watched all this. All right. It was obvious, but the panickers got wiped out. Okay. Make smarter choices. It's your time. Your retirement account. Look, you have control. You can break it up any way you want. Okay. I don't care. You don't have to care anymore if you become a member. Okay. Because you've got, you budget yourself out so that again, remember, when your income dries up and you no longer are earning and you're depending on your retirement, then you have to make sure you know where that's all going. And you have to also know the rate of return so that you don't have to go below zero, right? I mean, it becomes a big thing. But for us, this is what they recommend, right? This is your standard recommendation: bonds, short-term, in stock. Look, I'm telling you, you can do whatever you want. Okay, if you're going to hedge properly, this becomes antiquated. Okay, I don't own one bond. I'm 65. Okay, I own 0 bonds. Well, I might have one from my bar mitzvah in 1970. Okay, one of those series triple whatever E bonds, 1875 or a $25 bond. Anyways, you can do whatever you want as long as you buy securities that are liquid, or you can beta weight out a portfolio. You don't need to be in bonds. That's up to you if you choose. But again, I want to be in the highest yielding things I can be in, especially when I have protection. Okay, again, we all have a little bit of asset allocation. I mean, again, I'm as I said, bonds I don't own any. I own real estate, I own commodities, but my 90% of my holdings are in stocks because I can hedge stocks and I can control them, and they're always going to be liquid. Okay. Great to be hedged. Thanks for all you do for us. It's always a pleasure. Now, this is one of my live portfolios. Okay. And this is what we did on October 19th, a special day, right? October 19th, 2017, not 1987, is we bought $250,000 worth of all the 5 major ETFs. Okay. And you can see where we started at. Okay. We started with 1,080 shares, 1683, 1690. Boom. Now, these are the shares I hold today. Oops. These are the shares I hold today. Okay. And here's all the costs. Okay. And you can see that the opening value was 1.2 million. Okay. Currently, that 1.2 is worth 2.03. Not bad. Pretty good return, right? But the hedged is worth 4.8 million. Okay. Think about that. Think about the extra accumulation, the extra compounding, the dividends. Okay. Again, so we haven't sold a share. Okay. So, and here's where it was back on April 24th. Okay. About 10 months ago. Okay. This was up a little bit, and this was up substantially. You can see the accumulation of shares. Now, this is from a member. Okay. And again, I don't verify everything here because it's not mine, but I will tell you that the principle is right. I know others have looked at it. But again, this is the general idea. Okay. And this started out with $100,000 worth of spiders, SPY. Okay. Which was at the time 367 shares. That 100,000 today is worth 162,000. Now, this started 204 weeks ago. So it's almost 4 years. Okay. Not bad. Pretty good return. Okay. But hedged, it now has 984 at a value of 431. Okay. So again, I don't claim to give you those types of results. I'm showing you what has been shared with me. Okay. But I can claim that you will be protected as long as you follow the game plan and you use the right percentages. And especially if you're using the software, because it trades for you automatically. Okay. But let me tell you, there's the equity curve from her portfolio. Okay. So again, the blue is obviously the hedged and the orange is the unhedged. I mean, corrections are going to happen. Even just in the last 2 weeks, we had a nice little correction. Okay. It was great for me. Bought more at the bottom, sold them at the top, went down again, bought more again, rehedged up at the top again. I mean, pretty good. But in the meantime, I mean, these are math numbers. These are what was historically what has happened in markets. Okay. And, again, I'm not telling you it's going to happen. I do believe we have a very big correction coming. I believe we're going into a bear market right now. Okay. Now, again, it doesn't mean it's going to be tomorrow. And right now, just full disclosure, I'm net long, even in my other portfolios. So again, I'm going to I disclose my positions every day. Okay. Keep your head in the game. Listen, it's a long-term perspective, this business. Okay. If you're going to be worried about tomorrow on every single trade, you have no chance. Okay. Don't panic. If you panic, the first one to panic loses. You ever hear in a sales contest, the first guy to speak loses. Okay. Don't let tax considerations get in your way of a strategy. I mean, if you think you should sell something, again, I don't sell, but if you think you should sell something and you don't because of taxes, and then it goes down and gets cut in half. Wouldn't it have been better to pay the taxes? Okay. You can't outsmart the market by timing trades. Okay. The only way to make money is to trade with the trend or to be protected by hedging and accumulate. Okay. And if you want to have the least amount of variance in your portfolio, then you want to hedge it. Okay. If you don't mind a bigger variance, then you go with the trend trading. Okay. Because again, trend trading can have long periods of ugliness only to come back and make big money. But again, this comes back to the mental and the personal view of individual traders and how they feel when it comes to losses. Okay. And certainly we have many of those services, and I tell everybody, if I only had one thing to do with my services, I'd be hedging. Okay. Fortunately, I do them all, but I would be hedging. But nobody ever cares until it's too late. Okay. And, look, the markets come down to three basic phases. Okay. You look at the market and you identify these phases, and it tells you what your expectations can be of that period of time. And it depends on what time frame you're looking at. Okay. If I'm investing, I'm trading under one time frame. I can tell you right now, coffee, for example, is in solid consolidation. Okay. It's churning, which tells us there's a much bigger move coming. But if I'm day trading, okay, I'm trading on 4 minutes, but the patterns still show up the same way. Okay. It just depends on the time frame that I'm watching. But if you recognize, okay, that markets move in cycles or in patterns, okay, and they're very geometrical, okay. I mean, here's the Russell, okay, and you start out the first phase of markets every market is born from congestion. Take a look here, okay? And this was not meant to be; it just happened to be. But here's a market that consolidated, so it was consolidating all the way, which means it was going back and forth between two levels, and it couldn't make a decision which it was going to go. And finally, it broke to the downside, and it trended lower, okay, and it's trending lower, which is the breakout to the trend. Okay. And you go from consolidation, which is the birth, the breakout, the trend is the life, and the death is when you get the almighty panic blow off, which we haven't had yet. Okay. But that will be something on heavy volume and so on and so forth. But again, those patterns repeat themselves over and over and over again through all time frames, through all markets, because all markets are the same, all patterns repeat themselves. It's that simple. Now, beta weight your portfolio. If you're holding, like, for example, and I use myself as an example, I'm holding a majority of my money is in mutual funds, not by choice, but by design of, my retirement, my profit sharing, my 401k for the company. They're only allowed to use mutual funds, which is fine. So I'm stuck. So I have to beta weight my stuff, okay? And whatever I do outside of that, I can actually hedge to itself. But if I show you, and this is just an example of if you had $500,000 worth of stock of S&P stock, or which we would use the spiders, okay? Now I always get the question, we can use the futures as well. We can use the SPX. It depends on the size of your portfolio. Okay, because if you look at it from a math basis, 100 shares of spiders, 500 shares of the mini S&P, 1,000 shares SPX. That is the size variance of what you're looking at. So 100,000, 500,000. So all I would do is divide the price of my portfolio, so it's worth 500, and divide the price of the ETF I'm using, which is the SPY, and it gives me just a little bit over 11. So we defer to 12. So I'm going to do 12 back ratio spreads. Now, the reason you use the back ratio is, number one, it helps cut from the time decay for those options who people understand options. The selling of the back ratio or buying of it, but with the selling of the heavier put, takes care of much of the time decay. Plus the fact that we roll out before the final roll of time comes in. I mean, for example, you're going to see June spreads today because next week, in fact, it'll be Tuesday, I happen to know, is 30 days from the March expiration, okay, which I'm in right now. And I'll be rolling to the June because we use the 4 major cycles: March, June, September, and December. Those are the triple witching cycles, okay? So I'll be rolling to June anyway. So this is what it would cost today. Okay. So you'd sell the 448, which is the at the money, and you'll buy just out of the money at the 446. Okay. And this is going to cost you $21.36. That's $2,136 per contract. Okay. Per 100 shares. Now we're going to want to finance out. We use iron condors, and I'm not an iron condor guy. I hate iron condors, except for when I'm using them in a hedging model. Okay. I would never do a naked iron condor because they don't fit in, but in a hedging model, they fit because we talk about using them to finance out our cost. Okay. But they do create, done properly, getting the proper amount of credit, they do create an annualized return, depending if you know how to use them properly, between 6 and 20%. Okay. In the meantime, I'm going to sell the iron condor, which is, I got a wide distance, and that's based on volatility, of course, in which I'm getting 84 cents. So I'm getting 42% of the credit. Okay. And of course, so it's 21.36 minus my 84. So my initial opening cost to hedge is $20.52. Okay. So if I take a look at it, there is the actual trade. Okay. Back ratio 1712 by 24, 21.36. Iron condor, okay, which has a good wide berth, $18 in the middle of it. Okay. And again, obviously the markets are pricing that in. It's not a gift. Okay. But we won't take less than 40% on a spread. Okay. On a credit. So here's your iron condor, which is helping finance it. Okay. And then every week between now, actually I do it every week of the year, and it's done automatically for me, but every week I sell iron condors. And so every week I will try to finance it out. Okay. And of course, when volatility is a little bit higher, it's harder to finance them out if you get lucky. But again, it's really not the core purpose. The core purpose is to protect and compound and use that. But if you want to know the math, so I'm hedging $500,000. Okay. I'm paying $25,632 for that hedge right now. Okay. For 500,000. Okay. I'm going to collect about 1,008 per week. So basically it's going to take me about 24 weeks to get my money back, which is not, we don't have that many weeks between now and the expiration. But again, the objective behind it is to continue to create yield and continue to lower the cost of my insurance, but also using my insurance to compound out and to add on, which is exactly what we do. But you'll enhance your yield, and it goes from 60 to 100 plus. Okay. And that all depends on where the compounding kicks in. Now, if you want to know the absolute cost for protection, okay, well, here, the SPY is trading at 449. That's where it's trading. When I did it, it was at 448, and now it's at 449 or 448.70. But here, based on 449, based on the hedge we did, our protection kicks in at 446. Okay. But we have to account for what? We have to account for the cost, okay, and the width of the spread. Okay. So we accounted for that, and we subtract that from 446, so my real protection, absolute certainty, comes in at 425. Okay. Which turns out to be about 4.7% risk based on 500,000, when the markets are expecting between now and June of 13% plus or minus. We don't know which direction. We know that the markets are pricing in a 13% move right now between now and June. Okay. And that is, you can do that in any portfolio, on any stock. You can determine what your absolute math protection certainty is. Now, that doesn't include what happens on the way down there. If it happens to come into play, okay, the math could change. It can never change to your detriment. It can only change to the positivity for you and me. Okay. We've accounted by just pure numbers here. We're not accounting for anything else. We are taking it, and I'm showing you the worst possible result versus what could be even better. Because of course, when volatility first pops, we are big benefactors of that. So there's a lot of things, but again, that's immaterial. I'd rather you understand the raw numbers and the worst possible protection, which is 425.64. Okay. And of course, how does it work? Well, we're creating a back ratio spread, which again accounts for the time decay, which everybody worries about. Okay. And we roll it if you understand options in a quarterly option, which is what I was brought up on, that's how we trade. We didn't have anything else back when I started. But in a quarterly option, the biggest decay comes 30 days in. Okay, so we roll it the 30th day. Okay, so we don't have that problem. And of course, we get benefit on the way up, and we create credits, and you continue to sell premium, protected premium around it to help finance it. But you never want to give up the upside of anything you're hedging, because nobody knows when it's going to either explode to the upside or the next takeover is coming. And if you're short calls on top of it, you get no chance. You don't get the benefit. Okay, and this is over a couple of years. Every one of these red arrows we were buying. Okay, every one of these green arrows we were rolling up. We were rolling our spreads higher and locking in a new basis and accumulating more. And notice what happens. Okay, and again, in a bear market, it's the best. Because why? Because in bear markets, you get the most vicious rallies. You know, the best looking rallies are in bear markets, right? When they chase them up, to rip your face off variety, okay, which is perfect. So you get to do a lot of accumulated without hurting, and you get to continue to move up your basis, okay, and protect yourself. And we have the ability, okay, through Tradier, okay. First of all, we use Tradier. It's $10 a month, flat commission, okay. $10 flat. To me, that's enough, okay. But we actually can automate, and we have software, okay, that automates the hedging process of the class that you're going to sign up for if you decide to become a member, okay, and teach, okay. And the software, you get 4 months free of the software, and then it's a fee for the software, but it does nothing to the cost of your commissions. You're still $10 a month flat, and your portfolio is auto traded to your own personal directions of what you wanted to do based on what you learned in class. Now we'll teach you what we give you the best numbers, what we think are mathematically for you to do so, but it is a way for you to put yourself in a position, okay, to have it done automatically for you through Tradier, okay. And this is just another one of my portfolios. Now I'm showing you this one. This is a new one. I actually put this on when I was on Liz Klayman, and I said, you know, Liz, I don't think the markets are great here. I'm not really looking for a lot of stocks. So I'm just going to use the ETFs. So I put on an additional portfolio, and this is all through what I call risk reversals and synthetics, which I'm going to show you about. That's the IRA catch-up model, okay? But I'm showing you this because this isn't really stock. These are synthetic stocks, okay? Here's the real stock that I have accumulated in the last couple of months that I put on, which is a very healthy value of stock, okay? And I'm hedging against all of this. And when you're using the automated or the software, you get like this. I get your portfolio, Bob 0851, synthetic, okay, rolled up, okay. And here I rolled the risk reversal, okay. I'm using the synthetic stock, so I rolled this from 1 week to the next. I do them weekly, okay. And there's the roll, which is done for me, and it tells me that it finished, okay. Here is me buying more shares in the queues on what we call our roll down, okay. This is done automatically as well, okay. And I bought 10 more shares of stock, okay. I rehedged at a lower basis and took the extra profit and bought more stock, okay. And here is another roll back up, okay. So we went down and then we went up, okay. And that is what makes the model work, is the continuation of accumulating on the way down, adjusting your base on the way up, and putting yourself in the best powerful position to make dough, okay. And of course, you have made the complicated and impossible understandable and attainable. I can't thank you enough. You're truly amazing. Well, thank you, okay. A big part of living the life you want is taking ownership of your choices now and in the future, okay. So today, now I'm going to make you an offer, okay. But don't go anywhere, because I still got more, but I want to obviously get the offer out to you. But again, I got plenty more to teach you. Do something today that your future self will thank you for, okay. And that's what I believe in, okay. And I asked you 2 questions when we started. How would you like both protection and potential? And how would you like the benefit of compounding without stressing? Well, here's your chance, okay. It's your chance to step it up, okay. And today, the next class is going to start March 8th, okay. You can learn to hedge, okay, 8-week course, plus you get lifetime membership. In other words, every hedging course I do from now on, okay, and even when I stop doing them, I will do a quarterly review for all the hedgers, okay, as long as I'm alive, Okay. And I've got someone to take over in case, but you're a lifetime member for hedging for the education because markets continue to change. Okay. The models are ever changing because if they come out with new products, we figure out, again, we're going to always run the math. And, obviously we've been doing this for 10 years. Okay. And thousands of people have hedged. Okay. In the meantime, we have access to software. You've got access to me. I answer a lot of questions and I make sure that you have full understanding. Okay. And of course, my staff, which is me and Tom, okay, know how to handle everything and help you out. And so if you want to become a member today, that's normally $3,500. Today, $3,000. And with today, you get 4 months free of the hedging software, which is a $600 value. You get a webinar on building a trading plan. You get the Monday night strategy call every Monday. You get my free 6-session option course I just completed a few months ago, okay, which is 6 hours of training of options if you're new to options, okay. And you get the Vegas. We just came back from Vegas. Every year I do a big webinar. I do a big seminar live in Las Vegas, okay. And we have a great time. We work our ass off for 3 days, but that I have recorded, which you'll receive that too if you become a member today. Now all you got to do is go to bubbatrading.com/hedge. That's bubbatrading.com/hedge. And I'm just gonna put it in the chat for you. And then I'm going to show you how to take care of your synthetic trading. Okay, so that you can catch up. This is our what we call the catch-up program. Okay. And many of us have not done a great job of saving our money. We've either spent too much while we were enjoying and figuring out that it would never end, or we needed an emergency. And for whatever reason, our retirement account's a little skinny. Okay. And we want to get more. Okay. Well, you can use what we call synthetic stock. Okay. And then hedge the synthetic stock as well. Okay. But you have to create the stock first. And how do you create it? Well, there is an old floor traders trade, which was known as a true risk reversal, which you bought a call and sold a put that gave you the actual stock. Okay. But we wanted to do a little bit more because, again, people use these types of trades and margin and leverage, and it allows you to leverage up a little bit bigger. Okay. Now, we don't want you to get too big a leverage because the first thing you have to do is feel comfortable at what it's doing. Because when I show you this trade, which has a maximum risk of $652, okay, you're representing 19,800 of the IWM. Okay. Now, your exposure, like if I say it's got a risk of 5%, it's not 5% of $652. It's 5% of 19,800 up to the max of $652. You're leveraging, your risk comes on the leverage, not on the options. You're leveraging up to X amount. Okay. So your risk is based on what you leveraged to. Okay. And so here, I'm going to buy the call, sell the put, and buy another put. And boy, did these pay handsomely last week when the markets were cranking, or 10 days ago. Man, those extra puts were kicking in and paying some cash. So you were actually short for a few minutes while the market was getting hammered. Okay. But again, this will cost you $652. Okay. Which is, it's the same as the stock. And most of that comes from the margin requirement between 193 and 198. And here's what that trade looks like. Okay. You're representing 100 shares of stock that's worth 19,300. Okay. Maybe you want to do Apple. Okay. And of course, Apple is, you want to create 100 shares of Apple. Okay. There you go. Okay. Same trade. Now you can see the short expiration. Well, that's important. We can only use the short expiration because that's where the extra put becomes too pricey if we go too far out. Plus the fact that we have a method of rolling up the long calls when they're going in our favor to take a lot of the money off the table should the market reverse. Okay. And of course, that's what this trade looks like. So it's $582. And again, the spread risk is 500 of that. So the risk is tiny compared to what the reward is of using this stock. Okay. And again, you can create an entire portfolio, which I have myself. Okay. Out of synthetic, because I do everything first before I put it out to the street. Okay. I do. And I'll get to that in 1 second. Okay. Now, for all you lawyers out there who can tell me this is impossible, okay, my stuff is copyrighted, okay, or trademarked. Now, again, I know somebody can steal it, but every lawyer will say it can't be done. But that is the United States. That's not a phony. That's really, and not that I'm a big defender of the United States government right now, but that is a real trademark from 2016. Okay. So just so you know, any questions, I'll take them. Again, it's bubbatrading.com/hedge if you want to become a member. And I listen, I would tell you it would be wise to do so, especially in the current conditions, but I don't ever promote fear. It's not my shtick. We are going to have Canada. Yes. Okay. It's a great question. It won't be tomorrow, but I will say it should be by the end of the first quarter. Okay. Which is right around the corner. Okay. We do have an arrangement with Interactive Brokers. We will be able to auto trade now worldwide. Okay. We can now go worldwide. Before we were restricted to, everybody can use the software, but auto trading can only be done in the United States. Now we can go worldwide, starting probably in Q2, if not before, but I don't want to put the pressure on Tom. So yes, it will be done. It is being done as we speak. I just don't want to promise you by tomorrow, because if it's right tomorrow, you should be surprised. I will tell you it will be started in either the end of Q1 or beginning of Q2. I'm trying. Have I not tried for the Canadians? Who is a bigger advocate of Canada than I am trying to get pricing? You know how many times I flew up there to TD Waterhouse or those other guys trying to get deals for you guys? Anyways, any other questions? bubbatrading.com/hedge and bubbatrading.com if you have a question. So fire away if you do. But again, look, I'm hedged every day forever. Okay. And I've been hedged every day since I started this. And when we first started it, we didn't have weekly options. Okay. These strategies are built from a floor trader. Okay. The amount of capital you need for a risk reversal is, if you want to look at just raw, you can leverage up to about 2 times. So if you're going to do if you had 20,000, you can do 100 shares of the spiders. Okay. You're going to do 200 shares of the IWM. Again, you can leverage up to 40,000 to start with, but eventually when you understand it, you can go higher. You can actually go as high as 10 times leverage, but if you do it at the beginning, you should go see a doctor and have your head examined, because I'm going to tell you right now that if there's a lot of pressure on you when you're leveraged at that high, because the swings become much greater. Okay. And it's not that you have more risk. It's that you have more violent swings, and the real risk, remember, the risk comes off the amount that you're leveraging, not the amount that the options cost. Okay. So again, I can't be strong enough in reminding you about that the exposure is on what you are leveraging, not on the cost of the option. Okay. So if you're leveraging 10 times, so let's say you're leveraging 400,000 with 40,000, your risk is on the 400 up to the maximum price of your options. Okay. Anything else? So anyways, a new class is starting now. The good news is that we're just in session 4 right now of the original class. And if you want to come, anybody who joins me today can start Tuesday and start coming to class, because we go through the basics and it's not, overly complex, but you'll get to see the software sooner. Okay. And you can start making use of the software sooner and getting yourself comfortable, because again, look, I don't predict markets, but I see an ugly scenario developing. It is my personal belief, although I am long, okay, because I'm using my algorithms. So again, I don't want you to, I'm not going to give you something I'm telling you what I think. And my positions are net long right now. And I'm always net long anyways, because I'm always long in Hedge. But I do think we're in the start of a bear market anyways. Okay. And that's really what I think. Okay. 3A and 3B are what you want to watch, big boy. I just did them live. Why weren't you there? They're fresh, 3A and 3B. I had to break it into two parts. It was so much. How much cash should a total noob have to start trading? Well, I mean, baby steps. Look, you can trade with any amount you have, but if you have, you got to count the cost to join, right? So that's a big hit if you have a very small account. I would say that 15 to 20,000 would be fine because you'll start learning it and growing it, and you probably have more. Okay, or if you're younger and you have yet, you'll develop more. But learning the good habit, there's no price on good education of things that work. Okay, but I would say 15 or 20,000. Okay, unless if you're willing to go, if you had more but you want to try, you can go a little bit less. Okay, you're welcome, Bruce. But I don't want you to be stressed out at the beginning. The worst thing that can happen to trading, people that trade, is the heavy stress issue. Okay. Everybody thinks that traders just automatically make a fortune. They don't realize that we go through, ups and downs like everybody else. Okay. It's like every other business, but harder. So this is easy, but still it's work to be done. And you still have some small drawdowns. So, and when you're using leverage, okay, you're leveraging it more than you really have. So again, I want people to learn baby steps, as you said best. The lifetime membership means you get to come to every class that I do, okay, in hedging. Okay. Every hedging class, which I do about 4 times a year, you get to come by. You get to come to for free. Okay. Any updates, because again, markets are ever changing. You get to come. You get every recording. You have access to the website. Okay. If you took the hedging class, the futures class, you were invited. You may have ignored the email, but you were invited. Okay. And if you took the futures class, you get to come in live day trade with me every day at no charge. If you took the class already, you get that invitation every day too. I can't help it. You don't look for them. You get them. They're sent every day, like a clock. You know me, baby. 3 o'clock in the morning, out they go. The software itself is $150 a month. After 4 months, it goes to $150 if you want to use it. If you want the automation, you want to use the software. If you don't, you don't have to use it. That's up to you. You're going to learn. I always made sure that you learned enough that if you didn't want to use the software. But now that we're going globally, okay. But I will tell you honestly, it is well worth every penny. Okay, and not because I'm selling it to you. I don't really care. I mean, look, at the end of the day, I can retire and not teach anymore. I can just trade. That's what I've done all my life. And I went from working 4 hours a day on the floor and playing golf every day to working 18 hours a day. So I could certainly go back to, if there's still a floor, I'd still be there. But it's worth every penny of it to get freedom and just have it done automatically. But if you added it together from where you're brokering it now, okay, it'll be still cheaper. Okay. So, but thanks for the question. You're welcome. So again, it's BubbaTrading.com/hedge. J.O., what's up, brother? How you doing, man? What'd you think? You're always honest. You're always a straight shooter, me, baby. Okay. So, but again, I'm here to help. It's my objective. I have a high school program for kids, financial literacy. I like to educate people. And I'm really sick of the world, the way we're turning into. Okay. I'm sick of all the stuff, of the lack of knowledge that investors have. Okay. Because they don't know what to do and they depend on people that really don't have their best interests at heart. Okay. So it is my objective to educate as many people as I can. Okay. Which is why I do all these pre-games before every call, which is why I spend so much time doing what I do. But I guess if there's no other questions, again, it's BubbaTrading.com/hedge. Love to see you there as a member. But if not, hey, it was great to have you here and I appreciate your time and glad you could make it. Okay. But I can't force you to learn. I can only make it available to you. And that is my pleasure to do so. And I think you all have a wonderful weekend. Oh, hold on. I'll be in Vegas on Biz playing golf and Summerlin on Sunday, March 6th. I will be there. Are you taking me to Summerlin with you? No? Are you taking me to the golf? Are you taking me to the Summerlin, TPC in Summerlin? I'll be there. Yeah. Look me up. You got my number. Okay. So again, everybody have a wonderful weekend, and I thank you. And I will send out this recording. And if you have questions, feel free to ask me later. But again, remember, you get stuff that's worth, if you really did the numbers and bought it piece by piece, it's worth, I don't know, 8,000, 10,000. Okay. You're getting it for 3,000 today. Okay. And it's worth every penny of it. And not because I'm selling it, because again, like I said, I'm going to teach it. Okay. And I'm teaching it for my members. So have a great weekend, everybody. As always, I thank you for your time and your patience, and we'll see you next time. Have a great week, everybody.